See, basically, I have taken about 7 or 8 decisions where I feel that there can be a discussion on the correctness or otherwise of the decision. Plus, if time permitting, I have also taken up 2 subjects in the end that with reference to the position of the 148 notices issued validly prior to 31st March 2021, but where the proceedings have not been completed by the date and they have to be continued after 1/4/2021. What would be the validity of these proceedings? We need to, I thought that's a very interesting topic to discuss. So time permitting, we will discuss that also. And also I propose to discuss the certain observations made in the circular recently issued to implement Ashish Agarwal judgment of the Supreme Court. So first we will take.
You can keep some time and take it, sir.
Yes, I'll do that.
Yes.
Sure. So the first decision is with reference to Wipro Finance Limited. See, in this case, the Supreme Court was dealing with a case where the assessee is in the business of equipment leasing. It had purchased the equipment within India, and it also leased the same equipment to its customers in India. But to finance the purchase cost, it had borrowed in foreign currency. And as per the relevant accounting standards, the initial liability was recognized at the prevailing exchange rate as on the date of borrowing. It is not very clear from the facts of the case whether the assessee claimed an exchange loss either because of the actual repayment or the restatement of the liability at the year end. It really does not matter for the present discussion. So what happened was, when the assessee had to make the payment, there was an adverse exchange rate movement vis-a-vis rupee, and therefore the assessee incurred a loss. The loss was around 3.56 crores, out of which for some reason the assessee capitalized 2.46 crores and then 1.1 crore only was claimed as a revenue loss. The AO disallowed the entire amount and said 3.56 crores is a capital loss and it has to be added to the actual cost of the machinery and the equipment purchased by the assessee, and therefore he allowed only depreciation on that. When the matter reached the tribunal, the assessee filed an additional ground saying that even the 2.46 crore, which was capitalized in his books, has to be treated as a revenue loss. The tribunal, after discussing the matter in extenso, admitted this additional ground and allowed the 3.56 crores as a revenue loss. The department went to the High Court. The High Court held that the tribunal is wrong, and they said that the loss is a capital loss. So therefore, only depreciation is to be allowed. Now, the issues before the Supreme Court were twofold. One was whether the tribunal was right in admitting the additional grounds, and two, whether the High Court was right in holding that the sum of rupees 3.56 crores is not a revenue loss, but a capital is on a capital account which needs to be added to the actual cost. The department's contention before the Supreme Court was that in this case, the underlying asset is a capital asset, which is the leasing equipment, which have been leased to its customers. The assessee has treated these equipments as its fixed assets, and on the basic actual cost, he has claimed depreciation. Only the exchange loss has been claimed as a revenue loss. They also objected to the additional grounds being admitted by the tribunal. The Supreme Court said that as far as additional grounds are concerned, based on its own decision in the NTPC, held that the additional ground can be admitted as it is purely a legal ground, and the facts are already on record. No fresh investigation is required into the fact. The department was given an opportunity to raise his objections on this, and the department did not raise any objection before the tribunal and held that it was a fit case for the additional grounds being admitted. They did not find anything wrong with the tribunal decision on that point. The department relied on the decision in the Gates India 284 ITR 323, and the Supreme Court said that Gates India is distinguishable because that was a case where a fresh claim was made before the AO during the assessment proceedings without filing a revised return under section 139(5), and Gates India itself had noted that this decision will not apply in the case of appellate proceedings. So therefore, the admission of the additional ground is proper. Now, another important point which the Supreme Court held on the applicability of section 43A. It said that 43A would apply on its plain reading only if the asset is purchased from outside India. In other words, if the purchase of the asset is within India, section 43A as it stood there will not apply at all, and therefore the question of adding the cost under section 43A would not apply. Then the Supreme Court gave a finding that there is no dispute that the amount was borrowed for the purpose of business and in fact utilized for the purpose of business. Hence, the exchange loss is to be treated as a revenue loss. Support was taken from the decision in Empire Jute Company 119 ATR 1. Now, I have certain points which I would like the persons who are present today to discuss, give their views on this point. As far as the decision of the Supreme Court in admitting the additional grounds, I do not see any issue at all. I think the NTPC case has been correctly applied. Gates India has been correctly distinguished and in fact relied upon the last paragraph of the Gates India to say that if the additional grounds are purely legal grounds and do not require any fresh investigation into facts, the tribunal or the appellate authorities can always admit. There is no dispute on that point. Now, the important thing is that the attention of the court was not drawn to a decision or in Sutlej Cotton Mills, 116 ITR 1. In Sutlej Cotton Mills, what happened was the assessee had kept certain foreign exchange in a bank account in outside India, and then later on it repatriated that amount in India. As usual, it recognized the initial income at the prevalent exchange rate on the date of the receipt of the foreign currency, and when the amount was repatriated to India, there was an exchange gain. The issue there was whether that exchange gain is a capital receipt or is it a revenue receipt. The department held it's a revenue receipt and it's taxable, and the assessee claimed that it is a capital receipt. It is important to note a fact here that the Sutlej Cotton Mills decision is that of a two-bench division bench of the Honorable Supreme Court, whereas Wipro Finance consists of a three-judge division bench. This point we'll keep it in mind. In Sutlej Cotton Mills, the decision was that the profit or loss arising in account of exchange rate fluctuation would be on revenue account if the foreign currency is held as a trading asset. On the other hand, if the foreign currency is held as a capital asset, the profit or loss would be on the capital account. So the point is, what we have to discuss is that the ratio of the decision in Sutlej Cotton Mills is that if the underlying asset is a capital asset, or if the underlying transaction is a capital transaction and not a revenue transaction, then any variation of that amount, transaction relating to that amount, would be on capital field. If it is a trading asset, then it would be on the revenue field. So this is the actual ratio of the decision in Sutlej Cotton Mills. Now, we will apply this to Wipro Finance case. What is the underlying asset? The underlying asset is the equipment purchased by the assessee. And they are treated as fixed assets for the purpose of financial statements as well as for the Income Tax Act, because on the actual cost incurred, depreciation has been claimed and allowed. Only on the exchange rate loss, they said it is a revenue loss, and the department said it is a capital loss. So what is the underlying asset? If you apply the principles of Sutlej Cotton Mills, in my view, the decision in Wipro Finance may not be right. That is for the very simple reason that the Sutlej Cotton Mills decision was not brought to the notice of the honorable judges in the Supreme Court in Wipro Finance by the department, and the court did not have an occasion to consider that. But for academic purpose, can we say that the Sutlej Cotton Mills principle is a correct principle and therefore it has to be allowed? The second point is the Woodward Governor. The decision of the Supreme Court in Woodward Governor also is important. See, Woodward Governor, there were two issues before the court. One was with reference to the revenue transaction in respect of the year-end conversion of the exchange liabilities stated in foreign exchange. And the other was in respect of the certain liabilities which were taken for the purpose of acquisition of the capital asset. The assessee himself treated the exchange rate loss as an addition to the cost based on the year-end conversion rates. It was not actually paid. As you know, Section 43A, before its amendment, with effect from assessment year 2003-4, did not refer to the exchange rate arising only on account of payment being added to the cost. It only said any exchange rate variation will be adjusted in the actual cost. So the assessee's contention was, even though we have not made the payment at the year end, as per the relevant accounting standards, I have to convert the outstanding loan on the, at the year end exchange rates, and any variation on that is to be adjusted to the actual cost. The Supreme Court agreed with this view. Though this decision is not really on the point, I'm only saying that the Supreme Court went on the basis that any exchange loss relating to a capital asset has to be treated either as a part of the actual cost and nothing else, and it is not to be treated as a revenue loss. So maybe some support can be taken from this. The another decision of the Supreme Court which we may have to look at is the Mahindra and Mahindra Limited 404 ITR1. There, what happened was the assessee had purchased the machinery, which was treated as a capital asset and claimed depreciation, but he had bought it on supplier's credit, and due to some reason it could not repay that amount, and the supplier wrote off that amount. He waived that amount. So on that basis, the assessee contended that it is a capital receipt and it cannot be treated as a revenue receipt, and it cannot be treated as an income. The department contended contra, and the Supreme Court held that it is a capital receipt. So this is something a reverse of the situation, that I have incurred certain loss in respect of a loan taken for acquisition of a capital asset, and therefore it is to be treated as a capital loss. The fact that it cannot be added, whether it can be added as a cost, is a different issue altogether, though Section 43A may not apply. On general principles that on the basis of the accounting standards, we can say this increases the cost. That's one way of looking at it. So I would also like to inform you there are the amendment made from assessment year 2017-18, where Section 43AA has been introduced, where it says that if there is any variation on exchange rate, it will be treated on revenue account as far as the underlying transaction is a monetary monetary asset or monetary liability. The loan taken in foreign exchange is treated as a monetary liability for the purpose of the accounting standard 11 issued by the ICAI, also under NDAS, also under the company's accounting standards rules. So therefore, there is no dispute that from assessment year 17-18, the loss or gain in respect of the foreign exchange loan on settlement of a foreign loan would always be on revenue account. There is one more point which I have not discussed this, but I would like to throw up for discussion is this. The Supreme Court said in the last paragraph of Wipro Finance that the depreciation which has been allowed to the assessee has to be withdrawn for that year. There can't be any dispute on that. But the more interesting issue would be, see, the matter has taken so many years to reach Supreme Court from after the Wipro Finance case, from the initial assessment year. Possibly based on the decision of the ITO, AO or CAT appeals or subsequently High Court, the department might have only treated the revenue loss as an addition to the actual cost and then allow the depreciation on that increased WDV amount. Now, what happens to all the rest of the years? Assuming for a moment, it's not very clear from the facts of the case whether depreciation was allowed on the increased WDV for all the subsequent years. Let us assume for the sake of discussion, yes, it was so added. What happens to those depreciation which has been allowed extra because the original variation itself has been allowed as a revenue loss based on Supreme Court? This is another point I would like the participants to discuss. So with this, I would invite your views on Wipro Finance.
Any question,
Sharmaji,
friends? Yeah.
everybody will be on mute, so I don't know whether we will be able to. They will be able to
Okay.
ask questions or discuss.
But
Okay.
Because
either it can come on chat box or they can raise their hand.
Yeah,
They will be unmuted. No?
Sir, one thing I would like to say here is that whenever we talk of foreign exchange loans, there is one accounting standard 16, which is on
Yes, 11.
borrowing cost. Borrowing
11.
cost.
Yes,
11
on borrowing
16.
cost. Yeah. 16
Borrowing
is on borrowing cost. Yeah.
So what that says is that, see, since you are always, whenever you take a loan in foreign exchange, it is at a very nominal rate, much lesser rate than what otherwise you would have got. And any loss which is occurring because of transaction in foreign exchange on a loan, which the difference between the Indian rate, suppose the Indian rate is 10% and the foreign exchange rate is 4%. So to the extent of the differential 6%, will be considered as your finance cost and not as your exchange difference.
Okay.
The reason being that it compensates you to that extent for your finance cost. Had you taken that loan in Indian rupee, you would have paid 10%. Since you have taken loan in a foreign currency, you are paying 4%. So if there is an exchange loss to the extent of the balance 6%, it is treated as a finance cost. Probably that can also be one of the arguments which can be taken to take this, that yes, this is a finance cost and not because ultimately what is the purpose of taking a loan at a small lesser cost, and therefore it is a revenue expenditure. Can we say that?
No, my only point is that as far as the Income Tax Act is concerned, if you look at section 36(1)(3), it is very clear that what is allowed as interest is only the actual amount paid as interest. So the question here would be that whether it will be allowable under section 36(1)(3) is an issue. According to me, this will not come under section 36(1)(3). And if it is not coming under 36(1)(3), the only other section which can come is section 37. But 37 this is not an expenditure, because this is only a loss. So there is no outgo in that year. Even if there is an outgo, whether it can be treated as expenditure or whether it is a loss. So therefore, the whole thing goes back to the starting point of section 28, which is your net profit as per profit loss account. In computing your net profit, whether you do it, whether it can be treated as a revenue loss and then your profits are reduced accordingly would be the issue. It's a very interesting thing that AS 16 no doubt says that you have to treat the differential as a part of the finance cost, but whether it is interest under section 36(1)(3), because if you look at the definition of interest in section 224 capital A, it only says any amount paid for on debt incurred or a loan taken, and therefore I have a my initial reaction is that it may not be, we may not be able to treat it as interest under the Income Tax Act.
Okay, sir. Okay, thank you very much.
So you can move, sir.
Okay. So on depreciation, I would like to have some discussion whether it is what happens to the subsequent years, because there is nothing, no provision in section 155 which says that in a case like this you can automatically adjust the depreciation of the other years, or if it is beyond the limit of 4 years, at least even the reassessment may not be possible. Well, what happens when either 147 time limit, 149 time limit has expired or 154 time limit has expired?
It's a practical difficulty, sir. How to address it? It's
Sir,
very difficult.
Mr. Lakshmikant Naranji has raised his hand. So can we just hear him, sir?
Deepesh, can you unmute him?
Dipesh,
Yeah, just a moment. I am sorry, I don't have a host privileges, so I'm not able to unmute.
no, you are co-host once.
Lakshmikant, I have allowed you to talk.
Am I audible now?
Yeah.
Okay. Sir, as regards the withdrawal of depreciation granted in earlier years, can one not say that the recomputation as regards the recomputation of income for giving effect to the finding or direction, there will not be any time limit, and therefore within 153 it should be possible to withdraw the depreciation?
Yeah, there are two things. The expression used both in section 150 subsection 1 as well as in the explanation to section 153 says that in consequence of or give effect to a direction or finding of the Supreme Court, okay, of any court, okay,
Right.
either under the act or under any other act. Now let us look at the question. What is the direction of the Supreme Court? If you look at the last paragraph of Wipro Finance, there is a specific direction as far as depreciation is concerned. So that is the direction, and that direction is only for the relevant assessment year. It is not for the other assessment years. Even for a moment, let us assume for the sake of argument, yes, it is even for the other year, the depreciation adjustment is in consequence of. So now what happens is that then you have to look at section 150 subsection 2. So subsection 1, on the date on which the High Court gave its judgment, whether the 4-year period has lapsed for any of the relevant assessment years is to be looked into. If the 4 years period have not lapsed, possibly your view that we can do it under section 150 with subsection 1 with the explanation under section 153, those years can be adjusted, is a possible view. But if the time limit as specified in subsection 2 of section 150 has expired, then the department will be remediless.
Okay. Okay. Thank you.
Shriram has also raised his hand. I will just unmute Shriram. He has again put his hand down. He has again put his hand down, so we can continue.
Okay. The next decision which we will discuss is the decision of Supreme Court in Mahagun Realtors, which I'm sure will raise a lot of heated discussion on this correctness or otherwise of this decision. Let us look at the facts. The appeal relates to validity of the assessment orders passed on 11/8/2011 under section 153A for the assessment year 2006-7. In the case of the assessment was made in the name of the amalgamating company, which is the Mahagun Realtors Private Limited, MRPL. MRPL was amalgamated with the Mahagun India Private Limited, and the assessment was made on MRPL, which is the amalgamating company, which under general law is a non-existent company because the appointed date was 1/4/2006. On 27/8/2008, the group was subject to a search. Various documents were seized. Some of the documents pertain to MRPL. During the statement under section 132(4), the directors who were common for MIPL as well as MRPL when it was in existence, they gave a statement which was common under section 132(4). They said that in the course of this one statement that yes, MRPL had concealed certain income and it was not offered to tax. The directors did not mention that MRPL has been merged with during the course of such. I am not very sure whether there was any specific question asked by the investigation wing during 132(4), whether there was any amalgamation. So I'm not very sure whether that particular question was asked or not. Whatever the Supreme Court has reproduced in this one, it's only with reference to the concealment of income. So this is another fact. Another fact which we have to note is that when the 153A notice was issued and the return was filed, the return was filed in the name of MRPL with its PAN. Though on that day, the MRPL did not exist. Second point is, in that return, there was a column which said that any reorganization like amalgamation has happened. And unfortunately, it was mentioned as no. It was said that there is no this one on that. But there is some confusion on this, but generally looks like that during the course of the hearing, the assessee contended that it had informed the assessing officer that there is an amalgamation. MRPL has amalgamated with MRPL. This was this one. And in fact, assessee says on 30/5/2008, the department was informed about the amalgamation. The counsel for the revenue during the course of the argument says that yes, even though the assessee informed the department about the fact of amalgamation, then he says that because of various reasons, the assessment made on MRPL is valid. So there is an admission by the revenue that the assessee had informed the AO during the assessment proceedings that there is an amalgamation. The AO passed an assessment order describing the assessee as under Mahagun Realtors Private Limited, represented by Mahagun India Private Limited. Now, on appeal to a tribunal, it was held that the assessment is made in the name of MRPL, which is a nullity because it is non-existent. High Court upheld the above order on the department filed to the Supreme Court. Before the Supreme Court, the issue was only one thing, whether the assessment so made in the name of MRPL is valid or is to be annulled as a nullity. The Supreme Court held that the earlier decision of Supreme Court in Maruti Suzuki is not applicable for various reasons. Some of the important reasons which weighed in the mind of honorable judges, we will paraphrase it in the one. The assessee did not inform the department about the amalgamation during the search. So this is a finding by the Supreme Court, which we will discuss the correctness of finding a bit later. The second point is the Supreme Court itself notes that during the assessment proceedings, the assessee has informed about the amalgamation, but it was for the assessment years 7, 8 and 8, 9. Those assessment proceedings were relating to 7, 8 and 8, 9 and not for 6, 7. And therefore, the letter which was filed on 22/7/2010 informing this is not enough to say that the assessee has been informed. The third important point which the Supreme Court noted was that the PAN, despite the fact there is an amalgamation, the return was filed in the name of MRPL. It was filed with MRPL's PAN, and therefore the amalgamation, even though the amalgamation order passed on 10/9/2007, and hence this is one of the factors which led the Supreme Court to say that the assessment is valid. The directors considered that MRPL had concealed its income and they offered to pay tax on that. This is something which is very interesting. The Supreme Court says, in the case of an amalgamation, unlike a winding up of a company, the business of the company, the business of the amalgamating company does not cease. The business of the amalgamating company is taken over by the amalgamated company, and that is continuing to, and therefore possibly section 170, subsection 1 and subsection 2 would apply. This is something which is we have to discuss very seriously. They say because the business continues, the assessment can be made in the name of the amalgamating company. Please keep this in mind. This is what the Supreme Court says very categorically. The participation in the assessment proceedings were by MRPL. The correspondence of the department also it held out as MRPL. In the appeal also, the assessee describes it as MRPL represented by MIPL. Now, based on these facts and these decisions, in my opinion, these are the points which we need to discuss to see whether the decision of the Honorable Supreme Court is correct in law. This I am making with a lot of respect to the Honorable judges to say that why the decision may not be right in law. First, the revenue admitted before the Supreme Court that it was the AO was apprised of the amalgamation, as it's seen from para 11 of the page 203 of 443 ITR. Once there is an admission by the revenue, my submission is that how can the Supreme Court give a finding that the AO was not informed? Because this is the linchpin for distinguishing Maruti Suzuki. The second point is, despite the assessee submitting that it had informed the AO about the amalgamation on 22/7/2010, the Supreme Court says that that is only during the proceedings for 7, 8 and 8, 9, and not for assessment year 6, 7, which is in. Now the question would be this. Normally we know that a search assessment under section 153A, all the 7 years, the 6 years covered by 153A and the year of search under 143.3 are done simultaneously. So, and the important point is the assessment order was passed on 11/8/2011. On that day, whether the assessee, whether the information was given to the AO during the assessment proceedings of the concerned relevant assessment year or the assessment proceeding of some other year, it's immaterial. This fact is available before the assessing officer on 11/8/2011, saying that there is an amalgamation. So in that case, he should have taken the remedial steps. That has not been done. Then the important point is that unfortunately the Assessees Council has not. See, in the case of amalgamation, when the amalgamation petition is filed before the company court, the income tax commissioner, the jurisdictional commissioner of income tax is a necessary party to the amalgamation. He has a right of filing objections, and then the court has to hear if there is any objection. So once the jurisdictional commissioner is a respondent in the amalgamation proceedings, can the assessing officer say that he is not aware of the amalgamation? So this is an important point which we need to discuss and see whether it has any relevance, or despite the fact that the department is aware, unless it is shown that the AO himself is aware, then the Maruti Suzuki principle will not apply, is a point which we need to discuss. But more important question would be that whether an assessment can be made on a non-existent person at all. irrespective of the fact that the fact was brought to the notice of the AO or not brought to the notice of AO. Because the general principle, the fundamental principle is that the assessment has been made on a living person or an existing person in the case of non-living person. Therefore, the question would be that if it is brought at any stage of the time that the notice has been, the assessment has been made on non-existing person, then that assessment needs to be quashed. It might be a further point for the discretion of the court to either to set aside and tell the AO to commence the proceedings by issuing notice on the correct person, or despite the fact that the AO has been informed, in that case it becomes a nullity. Is an issue which we need to discuss that. Can the assessee be stopped from taking this jurisdictional ground even if the assessment is not informed the AO? The Supreme Court says that the MRPL participated in the assessing proceedings. There are two aspects to this. One is that whether a non-existent person can ever participate. Even somebody who holds out that I am so and so, it is the duty of the assessing officer to verify whether he is really that person. When he was informed that there is an amalgamation, when he says the MRPL has filed, he should have rejected that particular return and said this is not right. Therefore, he should have issued notice to MIPL and say, you please file the return. The second point important, though there is some discussion on section 170, subsection 2, I would like to, though I have not put it here, I would just like to bring it to your attention is this. Under section 170, subsection 2, where the successor, where the predecessor cannot be found in the case of a succession of business, the successor can be assessed in the year of change, succession, as well as in the immediately preceding previous year. But it is important to note that section 170, subsection 2 does not give a license to the assessing officer to make an assessment on the predecessor who cannot be found. Under section 170, subsection 2, the assessment has to be made only on the successor. This itself gives a clue that a non-existent person can never be assessed. So the question is that if once the amalgamation happens, how can MIPL say it represents MRPL? MRPL doesn't exist. So therefore, in my view, the decision in Mahagun Realtors, with due respect, is not right in law. And I hope that in an appropriate case, a larger bench will consider the correctness of this judgment. So we can discuss this.
Any questions or anybody would like to participate? Else we can move forward. If you raise your hands, we can unmute you.
Yeah, first of all, sir, the information was there maybe for another assessment year, but Supreme Court cannot say that no information, means it was not informed. And sir, you say that set aside is possible, but when we say when it's a nullity, then set aside also may not be possible.
Correct. No, that's also is my view, but then I was only just juxtaposing the factor that because the department was not informed. See, in the case of an individual, I don't know whether some of you may recall the decision of the Delhi High Court. I don't remember the citation. In the case of Savita Kapila, the Delhi High Court said that in the case of a 159 case, it is an individual case, they say that the legal heir has no liability or responsibility to inform the department about the death of the assessee. They say there is no provision in the Income Tax Act which requires him to do so, and therefore, if they, despite the fact that the LR did not inform the department, the assessment order is a nullity, and hence it needs to be annulled. Yeah, Mr. Sriram has raised his hand.
Sriram. Yeah, I have unmuted Sriram.
Yes, sir. Just one point I wanted to make. Old judgment of Supreme Court in the case of Jalandhar Vegetable Syndicate. it's a VAT matter. They said where a partnership firm has dissolved, even if they have not indicated about the dissolution to the VAT officer, even if he did not know about it, he could not have passed an order in the case of dissolved firm.
Correct. So this supports the stand we have, our understanding of the law.
Yes.
This decision was not brought to the notice of the court. See, the another point is which the assessee should have brought, according to me, is this: whenever there is an assessment has been made on a non-existent or a deceased, the law has specifically provided for that. You look at, in the case of death of an individual, section 159 says very clearly that the department can proceed against the LR in the case of the pending proceedings, and 159 subsection 2 says that even those proceedings which could have been initiated against the deceased during his lifetime can be initiated against the LR. Similarly, if you look at section 189, it deals with a case where the assessment of a dissolved firm after dissolution or AOP after dissolution. Similarly, section 170 talks about succession. So therefore, when there are specific provisions dealing with the succession or on the, for want of better explanation, say on the death of an assessee, be it a corporate or a non-corporate thing or an individual, the law provides for it, how to go about that in such cases. In the case of a company, there is no other specific provision than this. And hence, that is also an important factor which should have weighed in the minds of the judge. And he, in my humble opinion, he should have held that the Maruti Suzuki, according to me, has been wrongly distinguished, that binding ratio should have been followed.
Yes, sir. You can move.
We can proceed, sir, with the next.
Yeah. This case I have decided, I decided to discuss only to bring home the point that under certain circumstances, the court, because it feels that the assessee is entitled to some relief, they want to give the relief even though law may not strictly permit it. That is my sense after reading this judgment. Let us look at the... See, in this case, the assessee Creative Museum Designers is a company registered under section 25 of the Companies Act. The assessee was registered under section 12A and section 80G. Assessee's main activities is to design, conceptualize, design and construct museums and possibly act as a curator also. Now, for all these purposes, it enters into contracts with various persons. It participates in tenders if it is issued by a government body or a quasi-judicial government body, quasi-government body. So it entered into two contracts with the RBI for setting up a museum for imparting financial literacy, and also with Surat Municipal Corporation in respect of some museum which the Surat Municipal Corporation wanted to establish. For all these years, that is 2013, 14 to 15, 16, the AO denied the exemption on the ground that section 13(8) of the Act applies. The AO held that the assessee is mainly engaged in business and therefore it is not, its income is not exempt under section 11. The view was upheld by the CITA and the ITAT. This is an important finding of the tribunal. The tribunal held the assessee only acts as a contractor and the actual curating of the museum is with the customers like RBI, Surat Municipal Corporation. The museum owned by these entities and not by the assessee. So therefore, even the fact that the keeper of the museums is not the assessee is a fact which the tribunal gave, and this important fact has been upset by the High Court. The High Court looked into two aspects of that. One is whether the activity of assessee in setting up the museum attracts the first proviso to section 215 and consequently section 13(8) would apply. whether the exemption under section 11 can be denied when the assessee has been granted registration under section 12A of the Act, whether the assessee is engaged in charitable activities relating to education. The court held that conceptualizing, developing, and constructing and establishment of museum are activities carried out by a curator. Now, this is something which is a bit difficult to swallow, because a curator need not be involved in any of these things. The curator may even come into the picture after the construction is complete, after everything is over, and then he ensures that the museum is run on a proper lines. The museum collects the proper artifacts which require, keeping in mind the curator also decides the bona fides of the articles which are displayed in the museum. So these are the functions of the curator. Whether the assessee does this or not is not very clear from the facts. Assessee cannot be branded as a mere contractor. A museum is not merely constructed but conceived and developed. The fact that the assessee is registered under section 25 of the Companies Act, though not decisive, is one of the relevant factors in considering whether the assessee is a charitable institution or not. Assessee can be said to be in the activity of education. This is an important finding. Education, as occurring in section 2, subsection 15 of the Act, cannot be restricted to formal college or school education. Dissemination of knowledge through a museum or science park would undoubtedly come within the meaning of education. Assessee is therefore entitled to exemption. Look at the points for discussion. The first important point, which as far as education is concerned, the decision of the sole trustees in locus sectional trust, 101 ATR 234, the Supreme Court says very clearly that the education connotes a process of training and developing knowledge of students by normal schooling and has not been used in a wide and extensive sense. What happens in locus sectional trust case was the assessee claimed therein that I am running a newspaper. By publishing authentic news, I am educating the public, and therefore my activities are charitable. And hence, I am entitled to exemption under section 4 of the 1922 Act. The Supreme Court negated this contention and said the education is not used in that very wide sense of educating somebody through any means. You acquire, just because you acquire a knowledge does not become education. There has to be a formal training and development. Though there are decisions subsequent to locus sectional applying the principle therein that there is no need to have the education services rendered only through schools and colleges, but there has to be a systematic pedagogy and curriculum. There has to be a system of instructions. For instance, in the Bombay High Court in the Indian Banking Institute's case said that the Indian Banking Institute conducts classes, conducts examinations, gives certificates, and then imparts knowledge through a classroom and other matters, and therefore there is an imparting of education. Though there is no formal school or college as recognized under law, as far as the very fact that a classroom pedagogy is conducted, that would mean that there is education. But when a person visits museum, he does acquire knowledge. There is no doubt about it. He enriches his knowledge on various aspects for which the museum has been created. So if it is some art and painting, etc., you learn about the artist, you learn about the painting. Yes, it enriches your knowledge. But this education as understood as used in section 2, subsection 15. If you apply the locus sectional principles, obviously it is not. Then what happens, important point is that having held that it is education, possibly the court did not go into section 13(8) because the first proviso to section 215 is not applicable to education. It applies only to objects of general public utility, and not any other limb of the definition of charitable activities. The important point to note is that the court did not answer the second question. which we saw that once a recognition under section 12A is given, can the department say that you are not a charitable institution? The answer is no, because the Supreme Court in Surat Gymkhana's case has clearly held that the AO cannot question the decision of the commissioner. And once the commissioner says that it is a charitable institution, the AO cannot say that it is not charitable. The only thing he can look into is whether the provision of section 11 to 13 have been complied with, but he has to proceed on the assumption, on the fact that the assessee is a charitable institution. In this context, let us assume for the sake of argument that yes, there is a recognition under section 12A, and therefore the AO cannot question the charitable nature of the museum, these creative designers. But then the question is, when he applies section 13(8), is he not required to consider the first proviso to section 215 and give a finding that the assessee is carrying on a business? All of us know that the judicial opinion on cancellation of registration just because first proviso is attracted is clear. It's almost unanimous that just because first proviso is attracted, a registration granted cannot be cancelled under 12WA3. This is the consistent view of all the tribunals and the high courts on this issue. And therefore, yes, you can't touch the charitable nature. But when you look at section 13(8), it says that if you are carrying on a business, then you are not entitled to any exemption under section 11. So can't the AO say that, listen, I'm not saying you are not a charitable institution. I'm only saying that section 13(8) is attracted. Then the assessee has to contend that no, section 13(8) is not attracted because it's connected with the first proviso, section 2, subsection 15. And subsection 2, this proviso applies only to objects of general public utility, and I am not a general public utility, I am carrying on education. So therefore, the whole thing boils down to the question whether merely, even assuming the assessee is curating the museums, acts as a curator of the museum, whether he is providing education. That is a question which we need to answer, because if we come to a conclusion that it is not education, then the next question we have to go is whether section 13(8) applies or not. So we can have a discussion on this point now.
So strictly speaking, it cannot be considered as education.
Yes, sir.
It would be difficult to contend that it is education, as you rightly explained.
Yeah, but assuming it is not education, then what about the issue of the registration under section 12A being granted and whether AO can disregard it, or by invoking section 13(8), we can say that AO is not disregarding this one. So what is your view on that? Because that is more important for an academic discussion.
Sir, one Mr. Prakash Sinha from Delhi has pointed out that is it that now the judiciary wants to expand the scope of education? I mean, the definition of education as such with this.
See, my point is this: the High Court, without looking into the decision of the
Hello, can everybody mute? Otherwise, who are not participating? There are a few people who are. There is a disturbance which is coming on. Who's this? Yeah, sir, you can continue, sir.
Yeah, the point is, when you go through the decision of the Calcutta High Court in this case, we find there is no precedent cited on what is education. The court, as if it is holding for the first time on first principles that it is education. It is not that it is something trying to expand. It is not even referred to Lok Sakshana and try to distinguish or take support from some other observations of some other High Court or Supreme Court. It simply says that curating museums is providing education. So therefore, in my view, that the decision may not be right. We can't even say that it is trying to expand. It does expand the scope of education, but whether such an expansion is valid in law, my answer would be no.
Yes, sir, you would agree with that. Any other views from the participants?
No, sir. Dinesh, sir.
Yeah, Dinesh bhai.
No, it is a formal. See, now, so many tribunal and judge, they are liberally interpreting word education. It is not a rigid meaning school or college. So I think museum definitely it's a education. Because why in the school also teacher were taking to us museum for learning various history. This is nothing but education.
A museum can be education, but can the curator be an education?
Pardon?
Museum can be education, but can the curator who's just managing the museum be imparting education?
The school, just like running a school. Ultimately, museum must be supportive. No? It should be conducted. Otherwise, how we can run school also? Management is required.
See, if what you say is right, then all these both print versions as well as the online versions of various tax journals, they are also spreading education, assuming that they are not for private profit. Can you say that they are giving education by reporting all these things?
If we take liberal concept, definitely yes, sir.
Okay. But then Lok Sakshana has to be overruled by Supreme Court, no? Because Lok Sakshana is very clear. A formal system of pedagogy is a must. That need not, I agree with you that it need not be in colleges and schools or recognized institutions, but there has to be, like the Indian Banking Institute, they conduct classes, people go there. If there is an online class, yes, it can be education. That particular thing may not be a degree awarded as recognized under any law. It can even be a private certificate course. I have no objection on that being treated as education. But I just visit a museum, I enrich my knowledge, I read some book, I enrich my knowledge. Is it education? Is it so wide? Then everything can become education. That is the problem.
Yeah, you are right, sir. It seems difficult. Yeah.
No, I'm just giving an alternate view, not that I'm saying that I'm right or the other person is wrong.
No.
There can be always two ways. Nobody is right or wrong in law.
Okay, sir. Thank you, sir.
Yeah, next.
The next case is with reference to section 132. Okay, so therefore 132B, which deals with the application of the assets seized during the search. So section 1, this is the basic section. Now the question here would be that the facts are like this. Mr. Sangvi is a diamond merchant. According to him, his employee, Mr. Parveen Sheth went to the shop of Akash Diamonds to deliver the diamonds which were sold to him, to Akash Diamonds, and get the acknowledgement in the invoice for delivery. When Mr. Sheth was in the shop of Akash Diamonds, a search was going on, and then the diamonds were seized from the person of Mr. Parveen Sheth. And an initial statement under 132.4 was given by him saying that the diamonds belonged to him, and it was retracted later. Then Mr. Sangvi, what he did was he made an application under the first proviso to section 132B1. That said application was not acted upon. The diamond was not released within 120 days from the date of the last of the authorization of the search was executed. The last Panchanama within 120 days it was not done as required by the second proviso to section 132B1. Then a writ petition was filed in the Gujarat High Court for the release of the diamonds. The assessee contended that he is the owner of the diamonds and he has accounted the sale in his books. Since the diamond was not released within the 120 days as prescribed under law, the diamond should be returned to him and a direction to this effect should be given by the court. The department contended that as per the statement of Mr. Parin said that the diamonds belong to him as per the 132.4 statement given earlier and the retraction is not valid and hence the department cannot release the diamond to Sanghvi. The Gujarat High Court followed its earlier judgment in Dilip Bhai Panjwani 383 ITR 375 to say that once you have not released the seized assets within 120 days, no action has been taken within 120 days, either rejecting or accepting the claim, then it has to be automatically released, the assets. And therefore, they ordered the release to Mr. Sanghvi. My issues on this are this. First, is there a conclusive proof that the diamonds belong to Mr. Sanghvi? You look at it, the presumption under section 132.4a is that, though it's a rebuttable presumption, that if any asset is seized, it belongs to the person from whose custody the assets were taken. There are two aspects to this. One is that the diamonds were found in possession of Mr. Parin Sheth. And Mr. Parin Sheth was in the premises of Akash Diamonds. And Mr. Parin Sheth and it was Messrs. Akash Diamonds which were subject to search. So therefore, the interesting question that arises is that whether 132.4a presumption would arise in the case of Akash Diamonds or in the case of Mr. Parin Sheth. Because there is no warrant, there is no search. I don't know, the facts are not very clear whether the officer there could have issued a warrant immediately in the name of Parin Sheth. He could not have done so. Because normally what would happen under section 132.1, the authorizing officer should have reason to believe that the person will not do any of the items, things mentioned in section 132.1abc, small a, small b, small c, and he had no knowledge about Parin Sheth. He had only all information was only with reference to Akash Diamonds, and therefore my presumption is that there was no warrant in the name of Mr. Parin Sheth. If there is no warrant in the name of Parin Sheth and if the seizure has been made, whether it has been made from Parin Sheth or it is made from Akash Diamonds. Since the premises belong to Akash Diamonds and Akash Diamonds was subject to search, would the presumption under 132.4a would only be in case of Akash Diamonds, and it is Akash Diamonds who made the particular application for release, because if the diamonds have been sold to Akash Diamonds as contended by Mr. Sanghvi, then he becomes the owner. How can Mr. Sanghvi claim? Does he say that no, I have? He also says I accounted the sale in my books. This is one point which we need to discuss. The second point is section 132b3 says that the release is to be from the custody of the person from whom the assets were seized. Release to the same person from whose custody the assets were seized. Either we say that yes, the assets were seized from Mr. Parin Sheth or from Akash Diamonds, which are depending on which view you take. But definitely it is not seized from Mr. Sanghvi. So therefore, whether 132b3 would apply, then I would also take you through to section 132b3 and take another interesting question would be this. (132b3) says any assets or proceeds thereof which remain after the liabilities referred to in clause 1 of subsection 1 are discharged shall be forthwith made over or paid to the persons from whom the custody of the assets were seized. So therefore, what happens is that there should be all the liabilities mentioned in section 132B1 should have been satisfied out of the seized assets. And that can be done only after an assessment. Here the application has been made prior to the assessment, and therefore can Mr. Sanghvi contend 132B3 is not applicable because there is no assessment has been made. I have made an application under proviso, and all the proviso requires is that I have to prove to the satisfaction of the AO that there is a source for the asset seized, and therefore it is not undisclosed income. It does not represent any undisclosed income, and hence it needs to be released. So this is one issue which we may have to discuss, incidentally arises from this decision. And the point I want to make here is this. The fundamental question is that is the court right in assuming that the diamonds belong to Mrs. Sanghvi? When the department says that the ownership is not proved and the ownership is in doubt, without giving a categorical finding on that, and I'm sure that in a writ petition, normally that kind of finding cannot be given who is the owner because it's a question of fact. And therefore, without giving a clear finding by the assessing officer that the diamonds belong to Mr. Sanghvi, could the court have released the assets or diamonds to Mr. Sanghvi? Any?
Sir, here is it possible to say that the courts have just said that you release to whoever you feel because you have not taken any steps within 120 days, and therefore you.
Yeah, 1 minute, sir. I will just take that final direction of the court. I'll read it for your benefit. See, this is the final direction of the court. In view of the aforesaid, this writ application succeeds and is hereby allowed. The respondents are directed to hand over the seized assets to the writ applicant within a period of 4 weeks from the date of the receipt of this writ, within a receipt of the writ of this order. It is needed to clarify that the assessment proceedings, if initiated against Mr. Parin Sheth, with respect to the seized asset or even in the case of writ applicant himself, may continue in accordance with law. Direct service is permitted. So therefore, the court gives a clear this one saying that you release the assets diamonds to Mr. Sanghvi.
Achha.
So in view, this is the point. It is not that they say that you release it, let him hold it in custody or deposit, because the whole question is this. The court, in my view, should not have decided they should dismiss the writ petition on the ground that the ownership of the asset has not been established.
Yeah, without determining the ownership, how can they ask to return? Tomorrow it may not be belonging to Mr. Ashish Mr. Sanghvi at all.
Correct.
What would be the position of the department under those circumstances?
Exactly.
So either they have gone into the question of fact and determined that yes, this actually belongs to Mr. Sanghvi and therefore this direction, or otherwise it's a difficult proposition to tell.
Shall I go to the next one, sir?
Yes,
Yeah,
sir.
See, this decision I have only cited because personally I was not aware of that instruction of the board because this is a very interesting issue, because it may apply to maybe in some pending appeals, we can take this ground and try to get the order set aside, especially when we find on facts it's a bit difficult. See here what happened was, for the assessment year 16-17 and 17-18, 143 notices were issued, and also subsequently 142 notice was issued. The assessments were completed after considering the reply to 142 notice. The assessee filed a writ petition contending that the show cause notice as per instruction number 20 of 2015 dated 29/12/2015 has not been issued. Hence, the assessment is bad in law. The CBDT filed an affidavit contending that the instruction applies only to assessment year 14-15 and not to other assessment years. But it considered that principle of natural justice have to be followed. So on these facts, the court held that the instructions of SCM will apply to any year other than 14-15 also. That is, in this case, assessment year 16-17 and 17-18. Since the instruction has not been followed, what the instruction says is that even if you had issued a notice under 142(1), normally under 142(1), you seek documents and information. And even if you have given your prima facie view that something is allowable, or some expense is disallowable, or some income is taxable, the assessee is given an opportunity to file a reply. And after considering the reply, you should issue a show cause notice giving your, for want of a better expression, I would say your subsequent prima facie views, saying that whether it is taxable or not, or allowable or not. So this is what the CBDT instruction says. So the court says that there is nothing in the instruction to say it applies only to assessment year 14-15. It will apply to subsequent years also. And therefore, the AO was given a direction to issue a SCN, hear the assessee, and then take a final decision. As far as assessment years 18-19 onwards, there would not be much of a problem, because most of them would become either under e-proceedings or under section 144B, or under earlier section 143 3A and 3B, where these kind of SCNs were mandatorily required to be issued. So therefore, subsequent year 18-19 onward, there is no issue, because that is a procedure to be followed. But my question is that suppose we are an appeal for any earlier assessment year before any appellate authority, whether we can file an additional ground and say that in respect this particular show cause notice has not been given. He gave only a 142(1) notice. I replied to that, and he has concluded the assessment based on that reply, and therefore the assessment has to be set aside and it has been remanded back. Would this be a possible argument? I mean, only for that purpose I have taken this decision for discussion. Otherwise, I think there should be no difficulty in appreciating the correctness of the judgment.
Mr. Prakash Sinha says this is a procedural law and applies retrospectively.
Yes, correct.
Yeah.
Mr. Lakshmikant also wants to say.
Yes, Sanjay.
Could you please unmute him, sir?
So just give me a moment.
Yeah.
Yeah, I allowed him to talk.
Question is, yeah. Hello.
Hi. Yes, please.
The question is whether for other years also one can raise the additional ground, right?
Yeah.
So I think one can, no, because the NTPC decision and the Wipro Finance decision which we discussed today, because all the facts are already available on the records, and it does not require any investigation into the facts, right?
Yeah.
So additional ground, according to me, should definitely be possible. Only thing is that by raising this additional ground, we are again going into one more inning, you know. So whether really one should go for the set aside and get into another inning, or explain the case on merits before the higher appellate authority, so that the additional inning is avoided, is something which one has to consider.
Sir, I mean, please don't quote me, but what happens is, in many cases we find that on remand, the time limit specified in section 153(5) is not adhered to. The consequential order is passed much later. Okay. So therefore, once that if that happens, then you get away with everything. The assessing officer has to accept only your returned income. He can't do anything further on that. Okay. But then the point is this: in some cases, what will happen is that I don't know whether about the other benches. Unfortunately, in Bangalore bench, there is always a tendency to, the moment you file an additional ground, the moment you file an additional evidence, even if it is a very simple matter, they will simply say, yes, we admit this additional grounds and additional evidence, and we remand it back to AO or CITA as the case may be. Okay. So therefore, that remand happens anyway in many cases. So therefore, we can take this ground. And if by chance, if he doesn't pass the order within 153(5) time limit, it benefits the assessor.
Yes, but
it may just prolong the proceedings.
Yeah, but that will be at the tribunal level. As far as the CIT appeal is concerned, there is no power of remanding the matter back. So he will have to obtain remand report before concluding the appeal. So to that extent, the proceedings will get delayed.
Correct. I agree, sir. No doubt about that.
Yeah.
But I don't think, as things stand today, hardly any CIT appeals is posting any case. Except the ESA PF case, nothing else they are deciding under the faceless.
Yes, same thing here.
Wherever you are asking for personal hearing, they are not disposing of. Wherever you are not asking for the personal hearing, they are disposing it of.
Okay.
So possibly they do not have the infrastructure of personal hearing till now.
Okay.
Yeah.
See, in an appeal, not to hear you personally would be a travesty. Because we really don't know whether he understood what we have written.
You are right.
Exactly.
So written submissions becomes important.
Sir, the point is this, sir. What happens is that the language we use, whatever we want to convey, whether he is understood or not, is not. So at least in an appellate proceeding, when both the written submissions as well as the oral pleadings go, it will be always helpful for the appellate authority to understand what we are saying.
Yeah, but possibly now after that scheme of December 2021, they possibly still do not have the infrastructure of personal hearing, and that is probably the reason that the hearings where you are asking for the personal hearing, those appeals are not getting disposed of.
Okay, sir. Fine.
So you can move, sir.
The next question is a very interesting issue, because this is also something which I was not aware of it earlier, and then learned about it only after reading this judgment. So that's why I have selected this for discussion today. The issue is for the assessment year 2013-14, the notice was issued on 31/3/2021, because the 31/3/2021 was accepted to be the extended limitation available under TOLA. There was no dispute on that point. Both the assessee and the department went on that premise. The email notice was received by the assessee on 6/4/2021. Assessee filed a writ petition contending the notice has been issued beyond limitation. Please note the assessee's contention was not that it has been served beyond limitation. It has been issued beyond limitation. The department contended digitally signing the notice on 31/3/21 would amount to issue. On these facts, the court said, it noted the time limit under section 149 as extended by TOLA is up to 31st March 2021. It noted that the provisions of section 282(1)(c), which stipulates that notice can be served in the form of electronic record as provided in chapter 4 of the Information Technology Act. It noted section 282A and 127A, which provide for the manner of authentication of any notice issued electronically. Then more importantly, it noted section 13 of the Information Technology Act, which states that save as otherwise agreed to between the originator and the addressee, the dispatch of the electronic record occurs when it enters a computer source outside the control of originator. Relying on the language of section 282A1, the court gave a very important finding that there is a difference between mere signing of the notice and issuance of the notice. Because section 282(1)A says that a notice issued is deemed to be authenticated when the name of the person signing appears in the notice or in the attachment to the email. So therefore, they say that 282A talks about two events. One is signing, the other is one is the issue, the other is the authentication. Since the authentication is equal to signing a name, they say that merely digital signature of the affixing the digital signature would not amount to issue of a notice. This is a very important point which the court notes. Then, as per section 13 of the Information Technology Act, the issue happens only when the email enters a computer resource outside the control of the originator. See, what happens earlier, the control of the department was always handing over the notices to the postal department. Okay, so therefore, under these circumstances, they said that yes, when the postal department, when the letter is or the notice is handed over after the limitation, it is not issued within limitation, because until the expiry of limitation, it was within the control of the years. But in an electronic cyber world, what they are saying is that the issue happens when it leaves the computer resource of the originator. Since the email, then the court says, since the email reached the computer resources of the assay only on 6/4/2021, the notice is time barred. Prima facie, this looks all right, because what we are looking at is that normally in an email electronic communication, what happens? Most of things happen instantaneous. There may not be more than a couple of minutes of delay in doing this. But let us look at a case. But unfortunately, what happens in this case, the court has not really gone into the technical process of the delivery of an email. We know that we compose the email, we know to whom we have to send it, we put all those things, and then we hit the send button. Afterwards, what it happens, we don't know. In many cases, somebody says that they have sent an email to us, but it has not reached our inbox. It happened. So then we ask them to resend it. So in this case, what happens is that there is a possibility that despite sending at a particular time on a particular date, the message may not reach the inbox of the receiver immediately or instantaneously, though more often than not, it is so. My guess, I'm not very sure, I'm not a technical person. If somebody who is in the audience or one of the participants is able to throw some light, I would be very grateful to that. My guess is this: when you hit the send button, the mail from your local computer or the device, it goes into the server of your service provider. Whoever is your email service provider, be it Gmail or Rediffusion or BSNL, anything. So it goes and sits in the server of that particular service provider to the originator. Then that server would send it to the server of the service provider to the recipient. Then the service provider of the recipient, that particular server, will send it to the local system of the receiver, of the ultimate recipient. So this is the process, I think. So what happens is that in this process, there can be delay. It can happen due to queuing. Suppose the point is, if the server is overloaded, any of the server is overloaded, there is always a possibility that a queuing happens. The message does not get served immediately. So now in this context, if this is the process, operative word is if this is the process, the fact that it reached the assessee's computer on 6/4/2021 is immaterial. What the court should have looked into was, when did it go out of the control of the computer resource of the originator, that is the AO. That means if it goes and sits in the server of the service provider to the department, then that particular mail is out of control of the computer system of the AO. The fact that some delay happened subsequently is immaterial. If this particular message had gone within limitation to the server of the service provider or to the originator or sender, then we can say that it is out of its control and it has been issued within limitation. This particular point has not been discussed. I'm just giving an example. The department sends the email at 11:45 p.m. on the last day of the limitation. It reaches the servers of service provider immediately before 11:59. But due to certain technical problems, there is a delay and it gets delivered at 00:15 hours on the next day. Then in this case, can't we say that it is important to note that when the particular mail reached the server of the service provider, because once it reaches the service provider's server, the AO has no control over it. He can't retrieve it. So therefore, the court simply went on the presumption that the receipt in the recipient's computer system is instantaneous with sending by the originator. This may not be right. This is the only point I want to bring to your notice. And if any of the participants is aware of the technical process, kindly explain that so that we can have a better view of this. Because this is very important in the present context, because everything comes by email. So Mr. Giri, Ramohan Giri has raised his hand. Kindly unmute him.
Good evening, sir. Largely what you have mentioned is completely correct. I just wanted to add a small point. Generally, the service providers, especially the mail service providers, mail servers, sometimes it can be a dedicated mail server where something like departments or the large organizations, they will have their own mail servers. So they may not lean on the Google or Yahoo or other mail servers. So in that case, especially government departments, they'll have a common, their own dedicated mail servers. Then it will still be under the control of the department itself. So in that type of situations, if that particular mail does not leave the mail server of the department, then it cannot be considered as a valid service.
No, I would only ask you one small doubt on this, sir. Once it from the local system of the AO, it goes into the mail server of the department. Is there any way anybody in the department can stop that mail being sent?
Very much, sir. Very much in the control of the department, IT department itself.
Okay.
The technical team can still be withhold it.
Okay. Then if that can happen, yes, then it is in the control of the department as held by the Bombay High Court. It is not necessary that it should only leave the control of the AO. What is important is it should leave the control of the department. Only then the issue happens. If what Mr. Giri says is right, then in the case of a dedicated mail service, in-house mail service, then until it reaches the server of the recipient service provider, there may not be an issue.
Sir, I would like to add a small thing. Normally, the delay can be, maximum delay one can expect is about 15 to 20 minutes. Yeah. Beyond, it will never happen. A delay of more than 24 hours is unimaginable. In fact,
I agree. That's what I also thought. The important point to note is, but sometimes they say that when the client or somebody who has sent us the mail says that he has sent the mail, but we have not received it. So that is something which is perplexing.
So quite
But
often,
that is when it may go to some spam or something.
absolutely.
But usually that does not happen.
Okay.
Yeah, I mean, quite often when the large traffic on the department, especially on the last day of the deadlines, they send hundreds of notices. So because of that heavy traffic, other mail service providers, what they will do is they'll think that these are all spam mails, and then they'll put them in the junk mail folders.
So that is one possibility, but there is also a possibility that some servers may be down for some reason, and they may take maybe about a couple of hours to rectify it. So that is also a possibility. During that period, there won't be any delivery.
Sir, let me add one small point here. Digressing here, the spam folders, quite often what they will have is they have a limitation period. Beyond a particular number of, the spam will not be remaining in the folder. So when sometimes they may delete the older mails. So that's how quite often the SSCs will be losing out on some important mails also.
Okay. Thanks. It's a very important clarification. So,
Sir, today only I received a 143(2) notice, and in the notice itself they have written that please, as far as this email ID is concerned, just authenticate that it is from an authenticated source, so that in future none of your emails goes to the spam folder.
okay.
So now department is also instructing the SSCs on that.
Okay.
Sir,
So we
what
can
I
move,
have
sir.
observed is that when you go to the e-proceeding particular notice details, there
Just one
they
moment.
also,
Just one moment.
yeah.
Samarth, give me a glass of water, please. Huh? Okay. Yes, sir, please. I was just getting water.
So we can see the date of email also when we go to e-proceeding. So some in one of the case I had seen that the date of that notice was somewhere in the end of March, and the date of mail was 4th of May.
See,
On
that
the
is very
e-proceeding
clear.
side,
See,
yeah.
when the originators, this one mail sending time is given in the, we are able to trace it.
And the
It's
email
absolute-
address is also given, sent when and to which address. That is now appearing on in the
No,
e-proceeding.
I'm only looking at the intermediate process.
Yeah.
So in the intermediate process, whether it can be said that there is a, so therefore the point made Mr. Giri was very important. So we will keep that in mind and go to the next case, sir.
Yes, sir. Yes, sir.
Yeah. See, in State Bank of India, I'll just, because I want to discuss this one, I'll just take this case in a very, without going to detailed facts. The issue was very simple. The State Bank of India reimbursed the LTC to its employees who started their journey from their headquarters and then went to your destination was also in India, and they came back to their headquarters. But in this, the tour operator, he arranged it in such a way that the employees were able to go abroad. So possibly from the headquarters, they went to some place in India. From there, they went abroad, came back to another place, same place in India, and then returned to the headquarters. The State Bank of India, what it did was that they found out the shortest route, the direct route, and reimbursed that fare, not the actual fare. Then for this purpose, they relied on an Indian Bank Association circular, IBA circular, which said in such cases, when the employee does not take a direct route but a circuitous route to a destination, please find out the direct route fare and reimburse that amount only, and not the entire claim of the SS. So based on this, they took a view, that bona fide view, that the exemption is available under Rule 10, under Section 10(5), read with Rule 2B of the IT rules. The AO said, up to the tribunal, it was held that the just because the assessee, the employee went abroad during the course of the journey, the concession or the exemption given under section 10(5) is not available. This was also upheld by the court. The court seems to have gone on the premise that there is a legislative intent that if any person goes abroad, then the exemption under section 10(5) is not available. Then they also, very surprisingly, the court rejected the argument of the State Bank of India that it had acted in a bona fide manner based on the IBS circular and on its reading of the IT Act and the rules. So therefore, they rejected the bona fide belief theory and said that 201 proceedings can be initiated against the State Bank of India, and consequently penalty, etc., will be leviable. So the point for discussion on this case is very simple. Is the court correct in holding that just because the employees went abroad during the course of their journey, 10(5) is not? There is nothing in section 10(5) which says that you should not do it. All it says is that when the shortest route, whatever is the fare, direct, let's call it direct route, whatever is the direct route fare, you are eligible for exemption. Suppose you are going from Bangalore to Shimla, possibly the shortest route is to go to Delhi, and from Delhi to go to Shimla. On the other hand, if you go from Bangalore to Calcutta, Calcutta to Darjeeling to some other place, and then Shimla, then this is not the shortest route. But in this case, whatever is the shortest route as specified in the rules, that fare will be exempt. So why not apply this? Just because the assessee goes abroad, why the employee should be denied the benefit of exemption under section 10(5). The second point is, when the court talks about a legislative intent, they don't bring on record any of the materials to support that. They don't bring any, like the FM speech in the floor of the parliament, or the explanatory memorandum to the bill, or the circular explaining the provisions of the particular Finance Act, which made the amendments or the exemptions to section 10(5). Nothing of that sort. No contemporaneous expositor on this issue. It is merely the ipse dixit of the court that it is not the legislative intent to give exemption when the destination, not when the destination is not outside India, but when, just because during the course of journey you went to go abroad. So the question is whether the court is right. In my view, respectfully saying that the court did not approach the question from the correct perspective. Looks like that the court got prejudiced with the fact that there is some sort of a hera-fairy or tax planning done by the assessee to go abroad and claim it as an internal journey and then claim exemption under section 10(5). So this is the, and then on the bona fide is this one. Definitely the State Bank can rely on the Indian Bank Association circular, and it is, IBA is not some private body. It consists of the bankers of all the commercial banks of India, both nationalized and private, and therefore to say that the assessee could not have relied on the IBA circular is not right. Even otherwise, even assuming there is no circular, even if they say the IBA circular has no, cannot say on the IT aspect of the matter, or it is silent on that matter, still the question is this: on a plain reading of section 10(5) and rule 2B, can't an assessee or the employer come to this conclusion that the direct route fare is exempt, despite the fact the employee has gone abroad in the course of the journey? So these are the issues.
Yes, sir.
Right.
Sir, probably it could be that we don't know the facts correctly, but if that is a circuitous ticket without any stay in any place in India. It is just that because I want to take the advantage of the concession, I take a ticket instead directly from Bombay to Bangkok. I take it Bombay, Delhi, Bangkok. I don't stay in Delhi. Only from the airport directly I again board a connecting flight and go to Bangkok, come back in similar fashion. Can we not say that yes, it is purposeful tax plannings, and therefore, since you have not visited any place in India, you should not be given the concession?
I think if I remember it, many of the employees, what they did was they went to a particular place, from there they went abroad, then they went to another destination in India. Let us say that for just sake of this one, somebody went to Colombo, then after they came back to India, they went to Kulu Manali and then came back to their headquarters. So in any case, according to me, even if, see, the point is this, if it is, Delhi is only a place from which you are traveling abroad, then what you say is perfectly correct. Okay. But now let us say that in this example I given you is that the person has gone to Kulu Manali, but he goes to some place, let's say he is in Bangalore. First he goes to Chennai. From there, Chennai, he flies out to Colombo, then comes back to Delhi, and then takes a train to Kulu, Shimla, and then takes a helicopter to Kulu and Manali. Then there is absolutely no reason. The final destination is in India. And the example you gave, the destination Delhi, is en route to Bangkok.
Yeah,
I think we can move, sir. Sanjay, because sir has to.
Yeah, sure.
The next question, next issue, I'll just take. I don't have the citation of, because maybe it would have come in Tax Sutra. This decision was given only on 28th June by the Bangalore bench. Okay. So here the facts are very simple. The assessee entered into international transactions with his associate enterprise for the assessment year 2014-15. The assessee's case was selected for scrutiny under 143(2), and the assessing officer referred the matter to TPO for determination of the ALP. Both in the draft assessment order and in the final assessment order, the AO very clearly says that the matter was referred to TPO because the value of the international transactions were more than 15 crore. And the date of reference was 28/7/2016. And it was after the approval of the principal commissioner, the jurisdictional commissioner of the AO. During the TP proceedings, the assessee participated, did not raise any objection, nor did he raise any objections before the AO when some other matter under section 143 to 142 when were initiated. So finally, the assessing officer passed a draft assessment order where the only addition made was the TP addition, nothing else. So the TP addition was the only addition. The assessee filed a petition before DRP. For the first time before the DRP, the assessee claimed that the reference to the TPO is bad in law. The assessee said that as per the instruction number 3/2016, the reference can be made only under a few circumstances. The first of the circumstance is that if the case is selected for cause reasons, then there should be, one of the reasons should be TP risk parameter. That there is a TP risk parameter, the cause should say there is a TP risk parameter. Or in any of the earlier years, there should be a TP adjustment of rupees more than 10 crore, which has become final in appeal. So therefore, the assessee contended that I do not know what the cause reasons are because they have not been given to me. But definitely during the last, any of the earlier years, there is no TP addition of 10 crore. All the years where the TP addition was less than 10 crore, and most of them were in appeal before tribunal, where the tribunal has held in favor of the assessee. Most of the time, the TP additions were quashed. So therefore, the assessee submitted before DRP, please get the cause reasons, give it to us. We will make further submissions based on that. The DRP rejected this contention and said that this is on two grounds. One is that they said this is a procedural aspect. not following a procedural aspect is not fatal to the reference. Second point is that assessee did not raise this objection before the lower authorities, and therefore he is stopped from claiming this. They rejected this and then confirmed the TP addition. The assessee went to tribunal. Before the tribunal, the only argument was this, because the assessee contended that if this ground is allowed, all other grounds will become academic. So on this basis, the tribunal went into during the hearing before the tribunal directed the department to produce the files. What the department did was, instead of producing the files, they made the AO wrote a letter saying that it is true that the 143(2) cost reasons do not mention any TP risk parameters. So therefore, it became clear that the first portion of the instruction was not satisfied. But he said that the addition is more than 10 crore for the assessment year 11-12. Then the assessee submitted on facts for the assessment year 11-12. It is not more than 10 crores. What has happened is, by mistake, the TP addition was 1 crore and dot 0.77 paisa. Unfortunately, the AO forgot that decimal and took the whole figure as a TP adjustment for 11-12, which is not right, because for 11-12 the adjustment was only 1 crore 23 lakhs, and on this basis the AO or the tribunal held that the reference to TPO is bad in law, and hence the TP adjustment is quashed. To this extent, there is nothing much to discuss, because it is well settled principle that if the assessment is not made in terms of the instructions or the circulars issued by the board, then the assessment cannot be sustained on that basis. The returned income is to be accepted. But let us assume in this case, what happened, because there was no other addition other than a TP addition, the assessee said, okay, all right, if you delete the TP additions, I'm happy about it because I don't have to pay extra tax. So he did not press certain grounds which was taken. One of the grounds taken before the tribunal was that if the reference is wrong, if the reference to TPO is without jurisdiction, the final assessment order passed under section 143(3) is beyond limitation. Because this is on the ground that if there is no TP addition, the assessee is not an eligible assessee under section 144C. If he is not eligible under section 144C, then section 153 subsection 2 or 3, whichever deals with the normal time limit for a TP assessment to be 33 months at the relevant time from end of the relevant assessment year, is not applicable. It is only 21 months. The AO has not passed the final order within 21 months, though he has passed within 33 months. So therefore, if there is a corporate tax addition or any other addition which the assessee is agreed, can the assessee contend that because 144C is not applicable, the final assessment order is beyond limitation? This is the only point I want to discuss on this. Then we will go to the issue of 147.
Yes, sir, you can go.
Certainly, sir. Certainly, sir, that stand can be taken, and in fact, we can also say that the purpose of referring to the TPO was only for the purpose of extending the time limit for passing the final order.
Okay. So we conclude on that basis saying that yes, it is possible for the assessee to take this ground, and possibly the tribunal can say it is beyond limitation.
Yes, sir.
So now I am coming to an issue which so far has not been judicially decided. The writ petitions have been filed in Karnataka High Court on this issue. They are pending, but I am not very sure whether they will. Any other court similar writs are pending or not. I am not sure about it. The only issue on this, what we need to discuss, is this. Let us assume that a notice has been validly issued under section 148 prior to 31/3/2021. Okay. Now there is no doubt that the notice is valid, but the assessing officer has to continue the proceedings after 31/3 because he has not passed the assessment order before that date. There is time available for him under section 153, and hence he says that, all right, I am now continuing the proceedings. In this context, the question is whether the assessee can contend that without a saving clause in section 147, no proceedings can continue after 1/4/2021 because of the amendment to entire section 147 to 150 as per the Finance Act 2021. So this is the major issue. So let us look at what are the relevant statutory statutes which we need to look into, and what are the possible grounds on which the assessee can take this ground. First is we have to look at the impact of section 6 of the General Clauses Act. Why I'm looking at section 6 is that because it talks about a repeal, effect of repeal. You may kindly note, most of you would be aware that the Finance Act 2021 has substituted section 147 to section 150. So the courts have held that a substitution and reenactment on the same subject would also amount to repeal. So this is a well-settled principle, settled by the Supreme Court. Then the second point is a repeal would include a partial repeal. Once something is a partial repeal or a full repeal, then section 6 of the General Clauses Act would apply. Various decisions of Supreme Court which we have all seen, starting with Ashok Kumar Agarwal, Sudesh Taneja, Manmohan Koili, all refer to the fact that either there should be a saving clause under the special statute, or under the general statute, which is the General Clauses Act, section 6. So therefore, we need to look at section 6. I would draw your attention to section 6E. What it says is that where this act or any central act or regulation made after the commencement of this act repeals any, so either to, one moment, there is. Repeals any enactment hitherto made or hereafter to be made, then unless a different intention appears, the repeal shall not. Let us look at clause E. The repeal shall not affect any investigation, legal proceeding, or remedy in respect of any such right, privilege, obligation, liability, penalty, forfeiture, or punishment as aforesaid, and any such investigation, legal proceeding, or remedy may be instituted, continued, or enforced. And any such penalty, forfeiture, or punishment may be imposed as if the repealing act or regulation had not been passed. So in this context, what we have to look at is one minute. So what we have to look at is that whether section 6E can apply only if there is a right, a privilege, or obligation, or liability. Forget about the penalty forfeiture, which is not relevant for this. Can we say that when a notice under section 148 has been validly issued, the department acquires a right to proceed? This is the first point. I don't think that anybody will argue that department has a privilege to proceed or an obligation to proceed. But the only question is whether it can be equated with the right. If it is equated with the right, that the reassessment proceeding, the right to conduct the reassessment proceedings is equated with the right as in section 6E, then the subsequent portion of section 6 says that any such investigation or legal proceeding can be done. Then again, important point, we have to look at the opening portion of section 6, which says that unless a contrary intention appears. So therefore, we have to keep this in mind. Is there a contrary intention in introducing the amended section 147? So that we can say that section 6 does not apply, or we can say that the duty of the assessing officer is different from a right of the assessing officer. So therefore, it is only a statutory duty which is cast on him. There is no right on the department or the assessing officer to, which will come within the meaning of right as given in section 6E of the General Clause Act. So this is one point which we have to look at that. Then the point is on contrary intention. If you look at the finance minister's speech, if you look at the explanatory memorandum to the Finance Bill 2021, it very clearly brings out that the unamended section 147 as it existed from 1489 had led to a lot of litigation on reason to believe, etc. And the fundamental underlying factor is the reason to believe. Then only the assessing officer can pass an reassessment order or an assessment order under section 147. So the question here would be that whether these, and the finance minister says we want to put an end to all these controversies. We want to make a very simple procedural rule regarding reassessment. And hence we are amending the section 147. The same thing is repeated in the explanatory memorandum. So therefore, can we say that there is a contrary intention? Therefore, section 6 of General Clause Act will not apply. There is a contrary intention to say that not to continue with the old amended law. Old law, we don't have any intention of continuing, and therefore section 6 of General Clause Act will not apply is one point which we need to discuss further. Then what is important to know is this, the absence of a saving clause. See, as I said earlier, the absence of a saving clause can have two impacts. One is that there can be a saving clause in the particular statute, or the general savings like the section 6 of General Clause Act will apply. So therefore, the question here is that the legislature is aware that whenever they wanted to preserve the old law, despite the fact they have amended the law, there have been, they have made specifically provision for that. Look at section 142. 142.4 says that nothing contained in the section, as far as the, I'll just read section 142.4. The provision of this section, as they stood immediately before their amendment by the Direct Tax Amendment Act 1987, shall apply to and relation to any assessment for the assessment year commencing on the first day of April 1988 or any earlier assessment year. So therefore, there is a very specific provision which says that 142, the amended section 142 will apply to assessment years 88, 89 and earlier assessment years. And the new provision will only apply to later on. So therefore, there is a specific saving clause in respect of the past assessment. More importantly and directly to the point, we look at section 297. Section 297 2D1 says that where in respect of any assessment year after the year ending on the 31st day of March 1940, subclause 1 we will forget about it. Subclause 2, any income chargeable to tax had escaped assessment within the meaning of that expression in section 147, and no proceedings under section 34 of the repealed act in respect of any such income are pending at the commencement of this act, a notice under section 148 may, subject to the provisions contained in section 149 and 150, be issued with respect to assessment year, that assessment year issue. Therefore, even in respect of an assessment year which ended before the commencement of the 1961 Act, Section 292 saves the provision and says that under the new law, you can amend, you can issue notices in respect of the past assessment years, even prior to assessment year 62-63, which is the first year under 1961 Act. So therefore, in the absence of such specific provisions like this in section 147 to 150, can we say that there is no intention to save, and therefore section 6 of General Clause Act would not apply? Of course, second point is, as I said first, that it is a duty of the assessing officer under statute to proceed in accordance with section 147. It is not a right. A tax officer does not acquire any right because he is not personally involved in the assessment. It is not his personal case. There is no list between the income tax department and the SSC. All everybody is trying to do is to apply the law. So when you apply the law, there is no question of any right being acquired. So therefore, the 6E of General Clause Act will also not apply, is one issue which we have to discuss. So then we'll go to the next one, if time permits. So I would like the participants to give their views on this aspect. First, whether any similar writ petitions are pending in any high court?
Not to our knowledge, sir.
Okay.
Not to my knowledge, at least.
Then on first principles, kindly we'll discuss this, sir. How do we go about this? What is your view on the proposition made by me?
You are right. There is no saving clause. Then issue arises. No?
Only one point I would like to say is that if you carefully read Ashok Agarwal, Manmohan Kohli, or Sudesh Taneja, or even the Ashish Agarwal Supreme Court, they all talk about the notices issued after 1421. They almost say whatever we are saying is applicable only to notices issued after 1421 and not to a case before 31/3/21. Of course, they don't say that the TOLA would apply or anything like that to such notices, but they simply give a rider saying that this decision is applicable only when the notice is issued after 1421 under the old law based on the notifications issued under TOLA. Now, what I would like your views more is on the contrary intention which I was talking about and the right which I spoke about in section 6E of the General Clause Act. Because I would like to, because the department may argue this is what it is, that it is it's a right. So how do we say that that particular view is not right?
Any views from the participants?
So we are also thinking on the same lines, but not have we have not moved a writ yet, sir, on this.
Okay. But I think it is worth filing a writ petition on this. Especially if it is going before the Bombay High Court, you have a very good chance, Bombay or Gujarat.
We have told the client you take your chances in appeal.
Appeal, okay.
Don't want in writ petition because it's quite possible they will, if you try to argue it at this time, when it is fresh, they have a chance of remanding it.
See,
Or saying this is procedural. Okay. Once it goes in the
No,
regular course, we have better chances.
one more point.
Yes,
The
sir.
point is there are certain decisions which say that the law of limitation is procedural in nature, and therefore Section 6 of General Clause Act will not apply. They say Section 6 of General Clause Act will not apply to procedures. There is another view which we have to, which the department might use. Also on that way. So therefore, we have to see if it's a procedural law. Then we have to look at that also. If limitation is procedural law, what happens?
And they also say limitation acts harsh. Okay, you cannot save it by merely providing literal beneficial interpretation.
Yeah, that's right. The limitation has to be strictly interpreted, and all limitation provisions contain certain arbitrariness on it which can't be helped.
Sir, from 1st April to 30th June, you said whether the TOLA extends the date, sir.
Yeah, I will.
There also there are two views. Yeah.
So that is what I have taken in the next slide. But,
okay, sir.
We can go ahead with it because already it's 8:15. I don't know whether
you can take. No, you can take it, sir.
I don't know whether I'm testing the patience of the participants.
No, not at all, sir. It's very useful and yeah.
See, let us look at what I thought was that the department's understanding of Ashish Agarwal. So I would now, before we go for the individual slides, I would give my views on what Ashish Agarwal says. According to me, Ashish Agarwal completely agrees with the High Courts that the executive has no powers to extend under the TOLA in respect of the old provisions of Section 1 for the time limit for issuing notice under 148. The explanation which is given under the notifications dated 27th March 31 and 31st March 2021 or beyond the powers of this one, because para 7 of the Ashish Agarwal is very clear. They say that we completely agree with the High Court on its views, except that when they said that no proceedings can further be taken, and they said, okay, go ahead and exercising their powers under Article 142, they said treat those notices as a notice under Section 148 capital A B. In fact, it was never the case of the assessees before any of the courts that the department cannot apply the new law subject to the limitations and other constraints provided in Section 148 and 149. There is no contention saying that you can't proceed under the new law in respect of assessment year 17-18 or 18-19, provided the conditions are satisfied. So there is, according to me, Ashish Agarwal did not create any problem except that 148A. Now the point is this: what the board, when they gave the instructions on 11/5/2022 to implement the scheme, they made certain observations which are a bit disturbing, and I feel that they may not be right. Look at what this says. The board says, para 6.22 of circular says that board says that for assessment year 2016-17 and 2017-18, notice under Section 148 can be issued under Clause A of Section 149 as amended. See, prima facie, this is fine because you can issue a notice under Section for 2016-17 and 2017-18 under 149A, it can't be issued. The law is very simple because the amended Section 149(1)A says very clearly that it is 3 years from the end of the assessment year. Only 149(1)B talks about 10 years under certain circumstances. We will not go into that for the moment because the board says on 149(1)A, how can they do it for 16-17 and 17-18? Under what law? What is their this one? So the point is, according to me, this one, the board's circular on this point on 16-17 and 17-18 is totally against Ashish Agarwal. They cannot issue any notice after 31/3/2021. Look at I am just skipping one. Look at the third bullet point of this particular PPT. The board says we'll look at all this. The CBDT interprets the Supreme Court judgment that the direction given by the Supreme Court to treat the notice issued under unamended 148 as a notice issued under section 140B. They are treating this direction as a license to issue notice under section 148 of the new act without satisfying the provisions of the amended law. This is evident from the observations in the last bullet point of the circular, paragraph 6.1 circular, which states that the decision of the Supreme Court, read with the time extension provided by TOLA, will allow the 1 minute, sorry, there is some. Will allow extended reassessment notices to travel back in time to their original due date, and then new section 149 Act is be applied at that. This I am not able to understand. How can the TOLA will ever be applicable after 1421 when the Supreme Court says that we agree with the views of all the high courts that the TOLA will not apply in respect of 14/2021 notices. Once that is only the new law will apply. The old law, how can anything travel back in time? What is the meaning of that? Travel back in time to their original due date. The original due date was 31st March 2020 or 2021, depending on the TOLA extension. So if it is 31st March 2020 or 21, as the case may be when it is expired, how can the notice now issue under this? Because my understanding of Ashish Agarwal is this. The officer has to give reasons within 30 days from the date of Supreme Court judgment, that is 3rd May 2022, to the assessee saying that this is why I am treating you, this is the information I have got under section 148. Please treat this as a notice under 148A(b) and file your reply. Once the assessee files a reply, section 148A(d), he has to pass an order, and once that order is passed, assuming that he says that notice can be issued under section 148, then he has to issue a fresh notice under section 148. The notice issued earlier after 1/4/2021 does not survive. That notice has been transformed into a notice under section 148A(b) as per the Supreme Court judgment. That notice issued after 1/4/21 does not have the characteristics of a 148 notice. If you are going to issue a notice today in terms of a Supreme Court order, then that has to satisfy the new law. You can't treat this as a notice under the old law at all. So therefore, the board's view that something travel back in time to their original date and then new section, then they say that then new section of 148 Act to be applied at that point. What do you mean by that? This is totally confusing. I'm not able to make any sense out of this particular paragraph. So that is what, according to me, that the Supreme Court judgment can never be taken as a license for the department to say that TOLA will apply to any notice issued after 2021. That does not flow from Ashish Agarwal. Prima facie, the interpretation is wrong. This is what my view on this issue. So we can have a discussion.
Yes, sir. That is why we feel that TOLA do not apply to notices after 1/4.
Yeah. See, for the TOLA to apply, the due date should fall between 20th March 2020 and various dates extended by the notification, which ends on possibly on 31st March 21. Okay, as far as reassessment is concerned, because the law is amended. The courts have clearly said that the executive has no power to extend anything after 31st March 2021 as far as reassessment proceedings are concerned under TOLA. Because they say the Finance Act 2021 was enacted after TOLA came into effect. And Supreme Court completely agrees with the High Court judgment except that they don't want the department to go remedialess and say, all right, we will treat it as a notice under 148AB. You give the information, let the assessee reply. Other than this, nothing in the Hashish Agarwal to say that any notice issued will travel back in time. Just because he issued a notice on, let us assume that he has issued a notice sometime in June 2022 for assessment year 17-18, it cannot travel back in time to 31st March 2021. Because he is issuing notice under 148 today. So you look at section 149 now. 3 years from end of assessment year 17-18, March 18 ends on 31st March 2021. If it is 18-19, yes, there is no doubt about that. Provided you satisfy section 148, you must have information in possession suggesting income as escaped assessment as per the amendments, including the amendments, either the information which talks about the risk in the risk parameters of the board, or an audit objection, and the deemed information which is provided by the explanation 2 in the case of a search, etc. And the entries in the books where the amount is more than 50 lakhs, that is a time limit under 149(1)(b). Even under section 149(1)(b), the proviso to new section 149(1)(b) that no notice can be issued under the new law if no notice could have been issued under the old law. So, for instance, in assessment year 16-17, even if you are looking at the 2023, assuming extended limitation under the old law, if the assessing officer wants to do it under 149, he has to issue a notice before 31st March 2023. If he is going to issue notice after 1/4/2023, that notice is bad in law, even under the new act. Because by 31st March 2003, it becomes time barred. So for 15-16, the last date was 31st March 2022, no notice would have been issued, and therefore he cannot issue notice today. Even if he wants to invoke 149(1)(b. 10-year period may be available, but by 31st March 2022, that old notice could not have been issued. It became time barred. So in view of this particular observation of the board in para 6.2, etc., in respect of notices issued between 1/4 and 30th June 2021. So in fact, this circular does not even talk about 30th June 2021. It checks, they are talking about notices being issued after the Supreme Court judgment. You are looking at June 2022. So I was expecting a lot of discussion on this point.
I completely agreed with you. Any writ filed in this, sir?
Yeah, in Karnataka High Court has been filed.
Okay. Sir, we have taken this objection before the officer and are waiting for a AD order to be passed.
The only thing I'm not able to understand is that I thought when the Ashish Agarwal came, they may amend the act to make it very clear that they can proceed in respect of under the unamended law. Instead of relying on TOLA, they could have simply saying that if a notice is issued prior to 31st March 2000, the proceedings can continue like your 297 2D1 or section 142(4), 153(9). Easily they could have done that. I don't know why they are not doing it.
Sir, I'm told if they move an amendment to the section or want to introduce a new section, they have to give a reasoning as to why they want to introduce the section.
Sir, don't quote me this. There's a rubber stamp parliament is there which will approve anything.
No, I'm not talking about the parliament, sir. Parliament, we see what is happening. I'm talking about the minister.
Okay.
I am not about the parliament at all. About the VC, the debate that goes on in the parliament about finance act and all. Okay, that's not. I'm not talking. Before the minister, the chief secretary has to say why they have to introduce the amendment, and the only reason they can say is we missed to issue notices.
They don't want to say we goofed it up. They don't want to say we goofed it up and therefore
Yes.
that's
Yes.
okay.
That's the only reason I'm told.
Okay.
Yes, only sir, the related one related point is that on 29th March 2022, CBDT has issued a reassessment scheme. You know, and on as per that reassessment scheme, the 148 notices after that day needs to be issued in a faceless manner. Now, what I have seen is that after that 148 AD order, again the jurisdictional AO is issuing the 148 notice. So now considering that this scheme, which says from 29th March 2022, the notices have to be issued in a faceless manner. So naturally, this notice which jurisdictional AO issues after 148D order will be bad in law, right?
Correct. See, but one point I am not very, thank you for bringing this to my notice. I was not fully aware of this 29 March, or possibly I didn't. See, recently I also saw one jurisdiction notification issued on various these aspects, where they say that in some case the jurisdictional officer can issue the notice under some sections, but the proceedings will be continued in a faceless manner thereafter. I don't know whether any such thing is there in those in that scheme, but if the CBDT jurisdiction notice says notification says very clearly that it has to proceed, the notice under 148 also should be issued by the National Faceless Center, Assessment Center. Then if the jurisdictional officer issues notice, it will be bad in law. I don't think there can be any doubt on that.
Yeah, what he says is true, sir, that that notification is there, but we did not get whether there is any concurrent jurisdiction. See, such a big blunder, I don't know whether it can be done by them, because all notices have been issued by jurisdictional assessing officers.
The concurrent jurisdiction is different from simultaneous jurisdiction. In fact, there is a debate going on that even if the jurisdiction notice permits one officer to issue the notice and other officers to continue the proceedings, as held by the Delhi High Court in Valvo line and so many decisions of the Mumbai bench in Tata Limited, Tata Communication, and other decisions of the Calcutta Tribunal. The concurrent jurisdiction does not mean simultaneous jurisdiction. It only means that either of the officer can have assumed jurisdiction, and once one of the officers assume jurisdiction, only that officer can continue and proceed with that. So we have to examine that principle, how far it would apply to the faceless scheme and how far it is overruled by the statute on that. We have to apply our mind and take a view on that point.